Welcome to the Chrisman Commentary Daily Mortgage News Podcast. I'm your host, Robbie Chrisman. Topics on today's episode include the latest from the CFPB, my interview with Ardley's Nathan Den Herder on issues impacting servicers, avoiding frustrated borrowers, and proper recapture strategies in the modern age. And will rates help affordability? Not so fast. Thanks to today's podcast sponsor, Be Smarty. Be Smarty delivers world-class digital mortgage technology for banks, credit unions, and non-bank lenders. See the most innovative mortgage technology platform and deliver a complete digital mortgage experience today by visiting besmarty.com. My colorblind friend just moved to Denver. He says it's the capital of auto. Addo? Here in Denver at the ACUMA, a big topic is the regulatory landscape. Speaking of events, we're about a month away from the MBA's annual conference this year in Las Vegas, and those attending, setting up meeting spaces, or planning meals out have been confronted with portions of the strip being closed due to an F1 race in November. I was recently asked if the CFPB has gone away entirely, and if I'm hearing rumors of point banks coming back for LOs, and first off, I've not heard of any legal changes being made to LO compensation structures. All the rules are still in place. It's a matter of who is going to pursue infractions. No, the CFPB has not gone away. Although at the end of September, 1,500 or so furloughed employees may be fully riffed. Yes, we need a CFPB, but probably not one like we've had during certain administrations. And unless you live under a rock, you're probably aware that the Federal Open Market Committee cut its overnight Fed funds rate, and banks reduced their prime rates last week. Refi applications, per the MBA, jumped 58% in 1 week to 2020 levels. Remember those? But while lenders and vendors are cheering the new business coming in the door, don't look for an improvement in affordability. Even if mortgage rates go down to 1%, all that does is drive up starter home prices because borrowing's so cheap. Let's just be happy that combined refinance and purchase demand is up to levels not seen since early 2022. Mortgage rates recently posted their biggest weekly drop in 12 months, and plenty of rate sheets have 30-year rates in the low 6% area. Mortgage rates have come down enough to spur demand, but not restore supply. Remember that many borrowers still have rates below 6%, although a good percentage have refinanced in order to pay down credit card debt. The effective interest rate on mortgages outstanding is still about 4%, which is great for them. Rate cuts alone will not bring relief to the housing market. For home prices to come down, supply must rise. But builders have lagged demand for several years. Either significantly lower rates, that's 4% perhaps, or an external shock are needed. But no one wants an economy that pushes mortgage rates down to 4%. With inflation back on the rise, Fed rate cuts will probably be limited in scope. The result is moderately lower rates that will spur more demand, but not more supply. This sets up for even higher home prices ahead since sellers aren't budging and builders aren't building. For today's interview, I wanted to welcome back to the show Ardley Technologies' Nathan Den Herder to talk about the latest in the recapture game. He's on a mission to improve servicing, and he's doing just that via Ardley Technologies, which is directly responsible for introducing the only technology that allows servicers to transition from reactive portfolio management to proactive portfolio optimization.
Dare I say this is the perfect time to have you back on the show. I really enjoyed speaking to you previously, but you did just write a white paper, Navigating Falling Mortgage Rates, Maximizing Refinance Opportunities While Minimizing Risk for Lenders. And how did you know the market was going to be going down rate-wise right about now? We'd reach year-to-date lows. Had you been sitting on this, waiting for the right moment?
No, I actually have a crystal ball in my office here, and it told me that this was the right time to put this out. So that's why I did it.
Okay, good. It's certainly the name of the game in mortgage in general. You're seeing recapture strategies like crazy, both front end or top end of the funnel, acquiring lead generation companies or search services, whatever it might be, back end, acquiring servicing books, buying servicers, companies saying, okay, well, we have all this tech where our sales staff should now be freed up, focus on those relationships, stay in front of customers, win that business. it's almost like the Wild West that is going on out there. Before we get into the white paper specifically, you just talk about the general environment and why kind of this is so pertinent right now. I'd love your thoughts.
Yeah, well, I think a lot of people are really realizing that in a time when servicing is sticking around, people have lower rates. A lot of people have two portfolios. Really, they have one that everything was originated in the last 24 months, and then the stuff that was before that. And I think they're realizing that there's a lot of opportunity in selling all kinds of either a second mortgage or a rate term refinance or a cash out refinance to a lot of different sections of their portfolio, and that is really valuable. That's a really valuable relationship and a great way to protect that servicing asset and also to add value to borrowers. And it's cheap, by the way. That's the other thing that people seem to like.
So I've had a bad day. So we're going to be negative here to start. How are companies messing it up right now? I hear that borrowers are getting frustrated with recapture strategies out there. What is really stuff that should be in the past and companies should be better than, but that we're still seeing?
Yeah. Well, I'm sorry that you're having a bad day. But one of the things that I think people are messing up is, if you're going to try to get on the phone with a borrower, get a loan officer on the phone with a borrower, it should really be for an opportunity that the borrower is really going to find valuable and that they can really close. And I think one of the things to remember is, especially when you're talking about a servicing portfolio, you don't get that many chances to have a positive interaction with that borrower. I mean, usually they're thinking about you when they're paying their bill or they're paying their taxes. And I don't know about you, but like I'm not in the best mood when I'm doing either of those two things. But when it comes to being able to make their day by saying, hey, like, we have a really cool opportunity for you, we can save you some money on this refinance. People get excited, and then if there's a possibility that deal can fall apart and people feel like you wasted their time, then you maybe are doing something negative for your brand in their mind. And then when an advertisement comes along from another lender, then maybe they're more likely to talk to them. So I think it's really important if you're going to make an offer and target the customers that you have, that you take the extra step to make sure that loan can really happen.
Can we be a little more specific? We're seeing companies extend preliminary credit that doesn't actually qualify when it goes through underwriting. We're seeing them reach out to the wrong borrowers because they have them in the wrong buckets.
Yeah. Well, in my particular case in this paper, it's not really that the borrower doesn't qualify. It's the importance. I think what I'm trying to point out here is there is a nuance, and if you're not putting certain nuances in your analytics, you might wind up targeting borrowers that can't really close. So in this particular case, the example that I go over is one that we ran into the numbers have all been changed and there's no names, but it's a real example that we ran into in some of the Ardley analytics that we were doing for a real customer of ours. And this is an FHA borrower that really can qualify. The real issue is one of making the offer at the wrong time. So, as you know, right, most people escrow their taxes and insurance payments. And when you go to do a refinance, there's a moment in time where the taxes and insurance will be dispersed on a regular schedule. And the way escrows work, you're going to build up the amount of money that is going to be in that escrow account, and then the taxes and insurance get paid, and then it goes back down basically to zero. And the point is, if you make the offer at the wrong time, when you go to restructure the new loan, this escrow shortage needs to be taken into account. And the reason for that is because, toward the end of the year, you're going to make a tax payment and an insurance payment at the same time. And, on a loan of the size I talk about in the paper, that's like, $5,000, $6,000, $7,000 in some cases that have to be put in the escrow account because the county or the insurance company, they don't really care that you just did a refinance. They want their money when they want their money, right? That's kind of how that works. And so, this is not a question about a borrower that doesn't qualify. It's a question about whether when you make the offer at the wrong time, they might have to come to the table with $4,000, $6,000 that prime the escrow. Same exact credit criteria, same exact loan, same exact borrower made 6 months later, they only have to come to the table with $1,300, which is less than the amount that they have to pay every month. And so, that to me, this is a really classic example of, if you don't take the timing of the escrows into account, something that the servicers know full well because they're the ones that are doing the escrowing. If you don't take that into account, then what you can wind up with is, a borrower on the phone who's excited about a refi. And then after the loan officer kind of goes through the real example and takes a look at the situation, the answer is, oh, yeah, all you have to do to close this loan is bring 3 or 4 times the payment that you would have normally made. And for an FHA borrower who took the loan in the first place because they can go up to 97 LTV, right? The point of it is they don't have a lot of cash or they don't want to use the cash for whatever reason. Now you're saying to a person like, hey, all you have to do is cough up a bunch of cash to be able to do this loan. And it could have easily been avoided if you just baked in a little more of this analysis into the outbound offer that you made.
I want to get back to that analysis in a second, but I was thinking as you were saying that there's almost dueling narratives here. One is, hey, with our advanced AI technology, we can call borrowers all day. We can flood this all day. So
sure.
what is the cost of actually trying to do a deal and then losing it when technology has helped us so much? On the other hand, how do you, the other one to me is like this, turning the qualitative into the quantitative of you just pissed off a borrower and you're probably going to lose them to somewhere else now. Like getting companies to the point of being able to quantify more of it wasn't something that was on their radar enough to even realize they were pissing customers off and losing them.
I think one of the things that I notice is when it comes to the mortgage banks, at least lenders that I face off with, the marketing team and the sales team are two different people. And I think sometimes they may not talk enough. So, one of the pieces of feedback that I've heard recently, from a few different customers is, hey, when you can make the phone ring, that's great. But if I'm going to do 5 phone calls today and 2 of those deals are going to fall apart and those borrowers are going to be annoyed, I don't think that is an effective customer engagement strategy. And when you engage with the customer, it's both the message from marketing and the way the loan officer is able to interact with them. That both sides, even though it's 2 different departments in a mortgage bank, it's the same customer. And
there isn't a third department. What you said about realizing what the payment would be, that's not on marketing or it's even before that. It's some sort of having the analytics or the computer system figure that out. No.
Yeah, no, I think that's the point of that's what I'm trying to get across. And I wrote this paper to really highlight the timing issue and that you should be careful. I didn't really write this to say like, hey, the only way to fix this is to use the Ardley platform. I'd be more than happy to talk to people about that. But, I do think, when it comes to, making a lot of offers to your borrowers, I don't think you should avoid making offers to borrowers, but I do think if you make the analytics about looking at how the deal is actually going to be structured, if you make that part of the analysis for when you segment borrowers and who you're going to talk to, then you can put the right offer in front of them at the right time. Or at a bare minimum, you can say, look, Mr. and Mrs. Borrower, we have this offer for you. If we wait a little bit, we can close this with less cash up front. I think people would appreciate that sort of thing. So, I do think it's really important to get better analytics up front. And that means that when you make the phone ring 5 times for this loan officer, all 5 of those deals can really close. That makes their job more efficient. It makes the marketing more effective, and it makes the customers happier. I don't know who doesn't want all those things.
I was going to add to the old way of calculating. Should we hit them up to refinance? Are they 3/4 of a percentage point below? Is the market rate 3/4 of a percentage point below their interest rate? And that was it. Now with so much more data, predictive intelligence, those sort of things. What is a modern lender doing to really hone their recapture strategy and hit borrowers at the right time?
I think the most important thing you can do is try to really take into account your actual product pricing, eligibility rules, and the likely credit characteristics for that borrower. So, in the area of servicing, I mean, the credit score when the loan was originated. That's a good proxy for what it is now if that person's current. And then a lot of information about the property, where it is, the product type. And so you can recreate pretty easily the different LLPAs that went into actually pricing that loan. And so, instead of, I like what you said, right? Oh, the Freddie Mac 30-year fixed average is 6%, and this guy's at 7%, so we should call him. Well, that could work sometimes, but I mean, you can do better. I mean, you can run your product and pricing, and you can really figure out what that person can get, and then from there, you can also do the escrow analysis, and depending on the type of loan that it is, you can sort out whether or not this person is very likely to take the deal you put in front of them. And so I think, more like when people talk about propensity models and other things, a lot of it just comes down to a statistical analysis of, what these 3 or 4, maybe 5 factors are likely to lead to in the next 3 to 6 months. I think a more interesting thing to think about is, would you, the loan officer or the person doing the analytics in a portfolio, would you do this deal if someone put it in front of you? In order to answer that question, you have to do a little more than what people normally do. And that's part of what I'm trying to get across here.
Well, now's probably a good time to talk Ardley and some of your strategies that have really resonated with lenders out there. Because a lot of these lenders that have servicing books, no, we're good. We're good. This is what the dedication is of Ardley. What makes what you're doing so cutting edge? What's the focus for y'all? What's worked really well with borrowers?
Yeah, well, the thing that we try to do is give the borrowers as much information as we can up front. So when we are able to look in a portfolio, we can find a deal that we think a borrower should have, and then we can make the offer very, very specific for that person. And then, the second thing we try to do is work on improved engagement. So we have, after we do a solicitation, we have a thing called the Loan Navigator where the borrower can come back over and over again. And, of course, we're watching in our analytics on the engagement side that, borrowers are able to come back 2, 3, 4, 5, 6 times, and they're able to see what their rate is. And we watch that people kind of like the ability to come back over and over again, see what their options are, see how things are changing, and then on top of that, we try to make it a really easy experience with pre-filled point of sale and go through all the way to the end of the application, or as much of the application as our lender customer would like. And, in all of those phases, we're really trying to keep in mind, how the borrower is going to feel when they are going through that process. And so I think, an awful lot of people, they like to be able to see the information up front. There's a conventional wisdom out there like, oh, the borrower is going to shop, if we put too much information out there. Here's my feeling. I think experienced lending professionals know that the borrower is going to likely shop anyway, right? So, why don't you take a look at how much easier you can make the process, how more upfront you can be, and how much more trust you can garner when you've got that borrower's attention. And I think especially for servicers, when you can already overcome the scam factor because they know who you are, I think you ought to be able to do that. So anyway, yeah, we really try at every stage to take into account, how's the borrower going to feel if they're the one that has this offer put in front of them? Is it a good offer? Is it presented well? Have we given a lot of the information up front? And then have we made it easy for them to apply? I mean, that's kind of the thinking at all those phases of the transaction.
I like where we are as an industry because it's almost like the gatekeeping that has existed for so long is being thrown by the wayside. I'm LO, I'm the oracle of the rate, the LO. Okay, well, now there's ways for me to shop much better. I know, borrowers are more educated than they've been in terms of stuff. And there's more information online readily available. It's removed some of these frustrating layers of gatekeeping. And so let's look forward here. Once you've conquered recapture, what are some of the other friction points in the mortgage process you feel like are ripe for lubrication. I guess that's the opposite of friction, lubrication.
Yeah, I think it's an interesting question. I think one of the things that we're looking at now is actually, and we just launched our OneLink product this week. It's not so much about downstream from the application process. I think there's plenty of work to do there, but actually, the OneLink product is designed for lenders who might be a depository and have a large base of depositors or credit card or auto loan customers that they want to try to reach. So we're actually talking more about top of funnel work where we want to be able to help our customers engage people that are not in their servicing portfolio. It turns out you really only have to ask somebody 3 or 4 questions, and you can give them pretty much the same information that you can give them if they're in your servicing portfolio. So when we talk about our OneLink product, we're really saying, hey, if you have, even though they're not servicing customers, if you're an independent that has all the loans that you've closed in the last 5 years and you want to reach out to those people, we have a solution for that. If you have a large portfolio of depositors or auto loan customers, we have a solution for that, in this OneLink thing. And so, I think the good news is after you ask a customer 4 questions and save their data, you don't have to ask them again when they come back to the site. And so this re-engagement, along with giving our customers tools to deal even further up in the funnel, but also make it a very pleasant upfront experience, that's the next frontier for us. And that's what we're doing now.
I love where your head is. There's a lot of companies saying, oh, well, I can make underwriting a little better. Oh, well, I can make document drawing, whatever it might be. I'm going straight to the top of the funnel. I'm going to the servicing book. That's where it is. And it's like, if you can't get them in the hopper in the first place, it doesn't matter how good your process is. If you can't hit them at the right time, it doesn't matter how good your process is. So excited to see how this progresses for you. Always a pleasure talking, and we'll have you back soon.
Thanks, Robbie. It's great to see you.
Last week's economic data continued to support the narrative of pockets of positive activity offsetting weakening sectors. Retail sales rose more than expected, partly due to tariff-driven price increases, but showed only modest growth after adjusting for inflation. Auto sales were strong, helping to support industrial production, and domestic auto manufacturing expanded for the 9th consecutive month. However, overall manufacturing remained subdued due to high interest rates and elevated input costs. Similarly, single-family and multifamily housing starts fell 8.5% in August, on weak demand and increasing competition from resale supply. Permits fell 3.7% in August, suggesting that construction is likely to remain low in the coming months. All of this has put pressure on the labor market. While layoffs remain low, many businesses are not expanding payrolls. As a result, the FOMC moved to ease monetary policy last week in an effort to provide support to the labor market, despite inflation still above the preferred target. Should labor market conditions continue to weaken, the Fed is expected to continue easing monetary policy through the end of the year. This week's calendar includes month-end supply, Fed surveys, the current account deficit, housing data, and durable goods orders before Friday's PCE and Michigan sentiment. There's also a heavy calendar of Fed speakers, including Chair Powell. For MBS, Class D 48 hours notification is tomorrow. Today's economic calendar includes the Chicago Fed National Activity Index for August and remarks from no fewer than 5 Fed speakers. We begin the day with agency MBS prices roughly unchanged from Friday's close, the 2-year yielding 3.57 and the 10-year yielding 4.13 after closing Friday at 4.14%. Let's wrap up with a joke and some housekeeping. I talked to my school teacher friend the other day, and she's a school teacher in Los Angeles. On the first day of school a few weeks ago, she asked all of her first graders how many of them were Los Angeles Chargers fans. Of course, all of her kids raised their hands, except this one girl. She looked at the girl curiously and asked, "Why aren't you a Chargers fan?" The little girl said that her dad is a Denver Broncos fan, and her mom is a Denver Broncos fan, so she just naturally became a Broncos fan. So my school teacher friend told the girl that she doesn't have to follow in her parents' footsteps. With that, she asked the girl, "If your dad was a drug dealer and your mom was a bartender, what would that make you?" The girl scratched her head and then came up with the answer, "A Las Vegas Raiders fan." Thanks again to Be Smarty for sponsoring this week's podcast. It is the most innovative mortgage technology platform for banks, credit unions, and non-bank mortgage lenders. To learn more, visit besmarty.com.